times. Ladies and gentlemen, let's give a warm Steamboat welcome to Peter Wallison.
Well, it's wonderful to be here, and I must say I have to give a lot of credit to Jennifer because I've written a book, and it's an important book, I think, but what Jennifer saw in this book when it first came out, which was in January of this year, she saw that there was a direct connection between what I was talking about, or would be talking about when I described this book, and the desire of the organization here, the Steamboat Institute, to protect capitalism. There is a tremendous relationship between what happened in the financial crisis and the issue of whether capitalism is going to survive effectively in the United States. So let me get started on that a little bit because I think these are really important issues, and although the book involves something that most of you have experienced, you probably don't understand why you experienced that. Do we have the slides that are available for this presentation? They're coming up? There we are. Okay, that's the book. We all know that in the financial crisis, we had a lot of very bad mortgages in the financial system. What we might not understand is why there were so many bad mortgages and how these bad mortgages actually created a financial crisis. Can I change the slides by telling you to change the slides, or do you have a clicker of some? Oh, will this do it? Let's try that. Yeah, okay, that works. Well, I turned it off. Okay. Most of us really don't understand. Most people in the United States really don't understand why we had the financial crisis, why these mortgages led to a crisis. What we have mostly read in the newspapers, what we've been told by the government, is that it was the fault of the private sector. There was a lot of risk-taking, a lot of greed on Wall Street, and the private sector was insufficiently regulated. But, let's see. Well, let's see. The other direction. All right. That's not it. Oh, okay. That takes a little time. The facts actually tell us something completely different about what caused the financial crisis. And what you're looking at here are the entities in the United States that were holding the very low-quality mortgages, subprime and other low-quality mortgages in the United States in 2008, just before the financial crisis. On the left, the blue, and the red above it and the green above that is the government. These are government agencies. On the right, the black, that's the private sector. So right away, you should understand, anyone should understand, that the government created the demand for these mortgages because these mortgages were on the books of the government. The facts are these. In 2008, just before the financial crisis, more than a majority of all mortgages in the United States were subprime or otherwise weak mortgages. That was 31 million weak and subprime mortgages. Of those, 76% were on the books of the government agencies. The blue happens to be Fannie Mae and Freddie Mac. Many of you have heard about them. They were government-backed mortgage companies. They're still in existence there. They are, at the moment, insolvent. The government is controlling them and supporting them. Just above that, the red is the FHA, the Federal Housing Administration, and above that are a number of other government agencies. But the point is that it was the government that called for and produced caused all of these mortgages to be produced. Now, I'm not trying to say that the private sector had nothing to do with this. We can see that about 25% of these bad mortgages were on the books of the private sector, but principally, if you were looking for the cause of the financial crisis, you would have to say that the fact that the government was holding 76% of all of these mortgages would suggest something about who was really responsible. Let me go to the next one. Now, why are we at this stage, 6 years after the financial crisis, why are we concerned about this issue? What you see here is a chart that shows the recovery of the US economy since the financial crisis and the recession that followed that. The black line in the shaded area is the average of all of the recovery since the middle 1960s. The red line is this recovery. And you can see that it is much worse than any recovery we've had in the past. That is the fault of something you just heard a lot about, the DoddFrank Act. In fact, sitting there in the audience and listening to the CEO panel, I was kind of amused because I've given this talk many, many times. And many of the people in the audience actually are in the financial business. And I've said, well, how many people here have encountered or know what I'm talking about when I'm talking about the DoddFrank Act? And very few people understand. Even in the financial business, they know that there's much more regulation. They know what they have to comply with daily, but they don't understand that it's all the result of a new act. And that new act, the Dodd-Frank Act, was adopted because of the diagnosis that the media, to a large extent, and the government itself has given to the causes of the crisis. We have been told that it was a lack of regulation of the private financial system that caused the crisis. Now, I've shown you the data that indicates that actually it was the government, but most of the things you see in the newspapers suggest that it was the private sector and that it was insufficiently regulated. So the Dodd-Frank Act was adopted in 2010. And that is by far the most restrictive, suppressive law imposed on the financial system since the New Deal. I want to talk a little bit about the Dodd-Frank Act because there's a clear relationship between the slow recovery we're looking at here and the slow development, growth of our economy, even after it came out of the after the recession that followed the financial crisis. There's a direct relationship, and that relationship comes through the new regulations that were placed on the banking system. What happened to our, there we go. The new regulations that were placed on the banking system in 2010 with the Dodd-Frank Act. Now, in this country, there are 23 million community banks. A community bank is a bank with about $10 billion in assets or less. That amounts to about 99.5% of all the banks in the United States. Now, those banks supply small business. But what's happened when all of these new regulations have been placed on these banks is that they have been required to withdraw substantially from providing new financing and credit to all small business. Now, 23 million small business, about 18,500 larger businesses. Now, what is a small business? That's less than 500 employees. Any business with more than 500 employees is considered a large business. Now, what is the difference then between the small and the large in terms of the impact of the Dodd-Frank Act? It's really pretty simple. Large businesses, those with more than 500 employees, are able to register their securities with the Securities and Exchange Commission, and they are able to get financing from the capital markets. They can issue bonds, they can issue notes, they can issue commercial paper, and other ways to finance their businesses. But small businesses, those below 500 employees, do not find it easy or, in fact, sensible in terms of the costs to register with the SEC, so they get their financing from these community banks, the ones that are 10 billion or less in size. What happened with the DoddFrank Act? Now, one of the things that was adopted in the DoddFrank Act was something called the Consumer Financial Protection Bureau. Many of you may have heard of that. Many of you probably have seen some of the rules that have come out. Well, a couple of years ago, one of the rules from the Community Financial Protection Bureau was 1,000 pages long. It applied to J.P. Morgan Chase, which is a $2 trillion bank in New York, and it applied to a $50 million bank in a little town, say, in Colorado. Same regulation. But J.P. Morgan Chase in New York has hundreds of lawyers that can read and interpret this 1,000-page regulation for the bank. But the smaller bank has to hire a lawyer to read it, then has to hire a special person to do the underwriting that the rules now require, probably requires other experts to reconfigure entirely the way it relates to its customer base. All of those costs are internalized by the bank, this small community bank, and that means they have to hire employees that are no longer in the business of making loans or looking for new opportunities for the bank. In addition, there's a lot more regulation in which bank examiners come in and tell them how they should be conducting their business, because the bank examiners are now told by their directors in Washington that things have to be much more businesslike than they've been in the past. Instead of making loans to someone you've known for years in your community, someone who has never missed a payment, now you have to have audited financial statements from that borrower. The bank examiner wants to see those, and to the extent that they are not available, the bank is charged with inefficiency or lack of quality standards. So that, too, causes tremendous costs for each of these little banks, making it much more difficult for them to finance small business. Now, if that is all true, we should see a difference between the growth rate of the small banks and the small businesses and the growth rate of the larger businesses. And in fact, the data shows that. Since the financial crisis, since the recession that occurred just after the financial crisis, large businesses, that is those with more than 500 employees, have been growing at a rate that is consistent with that black line. That is, they're recovering at the rate that they always have in the past. Small businesses, those with less than 500 employees, are not growing at all. In fact, they've declined somewhat in size. So if you want to know why the U.S. economy is sputtering and not moving forward, why we are not seeing growth, it's because small businesses, which are responsible for about 64% of all new hires in our economy, are not being sufficiently financed so that they can get the inventory, they can grow, they can make loans that is, the banks can make loans that small businesses will be able to use to grow. So that's why it is extremely important to understand Dodd-Frank, the effect that it had on the banking system, and that, in turn, on the growth of the entire economy. All right, well, that's one issue. One issue we understand now is the reason we should be concerned about what caused the financial crisis is that we adopted a law that has made our financial system function much less effectively, much more slowly, and it will continue to do that as long as it's in effect. So I am part of a group in Washington at the American Enterprise Institute and some other organizations like ours to try to repeal the DoddFrank Act over time, because that's the only way we believe this economy will ever return again to the kinds of growth that we had before. Now, why did we have this problem? Why did we end up with a system in our mortgage financing business that caused this financial crisis, the collapse of all of those mortgages? And what I'm showing you here is something called the Affordable Housing Goals. These were adopted in 1992 by Congress and imposed on Fannie Mae and Freddie Mac. I mentioned them before. These are the two government-backed mortgage companies. And they were required in 1992, beginning in 1992, to make loans to low-income borrowers for homes, because Fannie Mae and Freddie Mac didn't make their own loans, but they would buy loans from originators like banks. And they were told in 1992, 30% of all of the loans that you buy each year have to be made to people who are at or below the median income in the places where they live. If you look at these charts, you can see that we actually started them in 1996, not in 1992, because by 1996 it had already risen to 40% up at the top. But there were three kinds of categories. One was low and moderate income, that is below median income. The next was underserved areas, those were largely minority areas. And then special affordable, those were people with incomes that are 80% or even 60% of median income. And so over the years, as you can see, those requirements went up. The black lines are the requirements on Fannie Mae and Freddie Mac. The red and the green lines are Fannie and Freddie succeeding in meeting those goals in each year. But what happens when you're required to buy more than 50% of all your loans from people who are at or below the median income where they live, or in some cases 80% or 60% of the median income where they live? Now, Fannie and Freddie were famous in 1992, before this law went into effect, for buying only prime mortgages. What was a prime mortgage? You had to have a good credit score. You had to have a 10 to 20% down payment. And after the loan was closed, you had to have no more than 38% of your income going for things like your mortgage or your credit card obligations and so forth. No more than 38% of your income was used for those contracted obligations. Those are the three standards. Now, they weren't particularly tough standards, especially the requirement for a 660 FICO score, that is a credit score. The average credit score in the United States is about 710. But those were the requirements before 1992. But once you're told that there's a government quota that says you have to buy mortgages that are made to people who are at or below the median income, at or below 80 or 60% of the median income, or minorities, you had to combine all those things together each year, what do? You start to reduce your underwriting standards. And that's what happened. Fannie Mae and Freddie Mac were the dominant players in the residential mortgage market in the United States. And as they caused their own underwriting standards to decline, all underwriting standards began to decline in the United States. So what happened after that? Let's see if we can make this happen. There, okay. What you see here is an enormous housing bubble. Many of you probably experienced during the period from about 1997 to 2007 a tremendous increase in the value of your home. This was the result of reduced underwriting standards. How do we know that? We know that because you can think about it this way. If a person has $10,000 to buy a home, and the requirement, the underwriting requirement is you have to have a 10% down payment, well, you can buy a $100,000 home. But if the government causes the underwriting standards to change so that you only need 5% for an underwriting standard for a down payment, you can buy a $200,000 home. And of course, that's what happened. There was much more money, much more credit chasing housing prices starting in about 1997, and that pushed up housing values. There's another thing that happens. The person who was going to buy a $100,000 home with a 10% down payment, a $10,000 down payment, has now borrowed, instead of $90,000 to buy the home, has now borrowed $190,000. So that is a much weaker borrower, a person with much more, many more and larger obligations than the person who would have bought the $100,000 home. So this built a tremendous bubble, housing bubble. And by 2007, it had gotten to a point where it was about all homes in the United States where this was affected, and this was almost entirely throughout this country, all housing prices had doubled in the 10 years. And as you can see, it was a much bigger bubble than the previous ones we had had. And there are always bubbles in any commodity, but they normally decline. They rise and then they decline, like the oil price we see every day. But this bubble didn't, and that's because the government kept forcing more and more money into the residential mortgage market in order to keep it bubbling. Now, this is not just in the Clinton administration. This all started in the Clinton administration, but it continued, unfortunately, also in George W. Bush's administration. In his memoirs, George Bush said, "I was delighted with the fact that so many new people were able to buy homes. What I didn't understand is all of the risks that we were creating by imposing those rules." So he actually now has understood what mistakes were made, but it's too late now to understand the errors. What all of us have to understand is that a decline in underwriting standards of the kind that we had starting in 1992 and extending through 2007 is not good for our economy, and yet it is the government's interest to reduce underwriting standards, not just to make loans to low-income people. That's a social policy. Government could have other reasons for doing it, but in part, all governments like to do this because if you get the housing market to grow, more people are buying homes, they're buying rugs, they're buying gardening services, they are buying all kinds of furniture, all kinds of things that make the economy grow. So the government wants to reduce underwriting standards, and we, the people, have to understand the consequences of that for us. Now, if you are someone who owns a home, you know, probably, if you tried to sell that home, you know that your home is connected with everyone else's home in the neighborhood. If your neighbor defaults on his car loan, has no effect on you. You might have to drive him to work, but there's no other problem for you. If your neighbor defaults on his mortgage, that affects the value of your home. And so all Americans have to understand that this is yet another thing that the government can do, which can cause huge losses for all Americans if we don't watch what they're doing. And we are doing it all again. And one of the reasons we're doing it again, and this comes to the point that Jennifer was making, do you believe that we'd have another financial crisis? Yes, the answer is we could have another financial crisis. Because the financial crisis we had came from government policies, and we do not understand what those policies were. That's what this book is about. This book tells you why we had these policies and why it is likely we'll be doing it again. And in fact, only a few months ago, the president said that he was going to reduce the FHA, the Federal Housing Administration, insurance fee by about half a percentage point. Well, what does that do? One thing it does is make it much more likely that people who are making risky mortgages, which are bought by FHA, people who are making risky mortgages are going to have more opportunities to do that. We're going to have more people taking big risks on their homes than we had before. In addition, the regulator of Fannie Mae and Freddie Mac said also several months ago, you know, you've been buying mortgages now with about 5% down payment. That already is too low. But you've been buying mortgages with 5% down payments. I want you to reduce them to 3%. Now, this is all part of the same process. And that process is the government trying to boost the economy by making the housing market bubble a little bit more. But it's dangerous for all the rest of us, so we all ought to be aware of that. So how did all of this then turn into a financial crisis? What you see here is a little chart of the mortgage-backed securities market. Most mortgages are held by banks and other financial institutions as whole mortgages. But many of them are packaged together into pools of mortgages. And then securities are sold against the income from those pools, which is principal and interest that people are paying on their mortgages. And as you can see, that was a very vital market up until about 2007. In 2007, just as the bubble collapsed, so did the mortgage-backed securities market. Now, that was important because most financial institutions held their mortgages through mortgage-backed securities. And the reason for that is a little technical. It has to do with accounting and regulations and government regulations, but the government actually gave the banks and other financial institutions an advantage in their capital requirements if they held mortgage-backed securities instead of whole mortgages. So most of them went in and bought a lot of mortgage-backed securities. But what happened here in 2007 is that the value of those securities declined to almost nothing. This is because as the bubble began to dissolve, as the bubble declined, an enormous number of new defaults became evident. The newspapers were beginning to report these defaults, and data about the housing industry was showing a huge number of defaults. So what happened is that buyers in the mortgage-backed securities market simply walked away. They fled that market. They did not want to buy. And because they wouldn't buy, the prices fell to almost zero. Now, it also happens that under accounting rules, financial institutions are required to carry their securities at market value. But you can see that they had, their mortgage-backed securities had almost no value by 2007 or 2008. And so that's why you were reading in the newspapers that X bank, Y bank, X financial company was in serious trouble. That's because they had to write down their assets. And when you write down your assets, your capital declines, and also, in some cases, you suffer direct losses under the accounting rules. So that's why we had something that looks like this, and there were many financial institutions all over this country that were in trouble. It's the relationship between that problem and the government's decisions that then caused the financial crisis as we understand it. If we had just left things alone, over time, these values would have come back, because what we had here was people fleeing the market until they understood more information about what was really causing all of these losses. But the government didn't leave it like that. There was a large investment bank on Wall Street named Bear Stearns. Many of you probably have heard that name. Bear Stearns in March of 2008 was in trouble because it was one of the major investors in mortgage-backed securities, and it looked like it was failing. And the government then decided, this was Hank Paulson, the Secretary of the Treasury, and Ben Bernanke, who was the chairman of the Federal Reserve, they decided to rescue Bear Stearns. Now, I say this was one of the major errors that has ever been made, one of the poorest decisions the government has ever made that has caused a serious crisis, to rescue an investment bank like Bear Stearns. But they did it. I call it the original sin. When they did it, they sent a signal to all the rest of the market that they're going to rescue all large banks, all large financial institutions. They won't let them fail. And that changed the way the managers of these institutions decided to operate. Because normally, when your assets go down, when your capital goes down, when you look weak or nearly insolvent, what do? You go to the markets and you sell more shares, because you want to tell your creditors that you've got plenty of equity under the obligation that you owe to them. But if the government is going to rescue everybody, what is the reaction of managers or creditors? In the first place, the creditors now stop being worried about their position, because they figure if the company fails, they'll be rescued anyway. And the managers of the companies say, well, why should I dilute my shareholders? The stocks were way down at this point. Why should I reduce my shareholders, or dilute my shareholders by selling shares at this low price? So I'll just wait this out. The trouble is that in September of 2008, Fannie Mae and Freddie Mac, those two very large government-backed institutions, became insolvent. And the government also rescued them. And what was the significance of this to most people? The significance was everyone still thought that Fannie Mae and Freddie Mac were only buying prime mortgages. No one understood how many subprime and other low-quality mortgages were in the financial system. That chart I showed you at the very beginning is entirely new. Nobody had that data in 2008. So when the market, participants in the market, realized that Fannie Mae and Freddie Mac were insolvent, and they, it was thought, were only buying prime mortgages, because Fannie and Freddie had never told anyone that they'd begun to buy these very low-quality subprime mortgages, people said things are much worse than I ever imagined they were, and then they began to pull their money out of all kinds of other financial institutions, including one very well known now named Lehman Brothers. Now, if the government had rescued Lehman Brothers after rescuing Bear Stearns, well, things would have gone according to what everyone expected. But the government did not, as you remember, rescue Lehman Brothers. They allowed Lehman Brothers to go bankrupt. That frightened everyone in the market and created a panic. And we saw then something that no one had ever seen. Regulators, academics, business people, others, the biggest banks in the country would not lend to one another, even overnight. In other words, they were hoarding cash. And they were doing that because the fear was that to the extent that anyone came to them and asked for cash, if they couldn't deliver the cash immediately, a rumor would spread on Wall Street that they were completely illiquid and they would be ruined. So they all hoarded cash. And this is what we understand to be the financial crisis. So, 3 parts to this problem. The government forces down underwriting standards so that it creates this gigantic bubble and a lot of very weak mortgages out in the financial system. A majority, in fact, 31 million such mortgages. Then the government rescues Bear Stearns, causing participants in the market to believe that that's their policy. They're going to be rescuing everybody. And then the government reverses its policy and causes a panic that we understand as the financial crisis. The result of this was the DoddFrank Act. And that's why, which came about because the government blamed the private sector for taking all those risks with insufficient regulation. And as a result of that, we have this very slow recovery that I showed you at the beginning. So this is the story, and this is why it is extremely important for all people in the United States to understand why we had a crisis. It's not because we didn't have sufficient regulation of the private sector. It was because we didn't understand what the government was doing when it was forcing what was essentially a social policy on the residential finance system by requiring Fannie Mae and Freddie Mac to buy mortgages that were not the prime mortgages that Fannie and Freddie had initially been famous for. So that's what this book is about. It is, I think, the only book of its kind that explains from the beginning to the end what happened in the financial crisis with an awful lot of data. And I should mention that I was a member of the Financial Crisis Inquiry Commission, which was set up after the financial crisis by Congress. Let me see if I can get something up here. Nope. Set up by Congress to tell the American people, to tell Congress, to tell the President what caused the financial crisis. And their effort, I think, was not intended to inform people. It was intended to create a foundation for the DoddFrank Act. So I dissented from the report of the Financial Crisis Inquiry Commission. I wrote a 100-page dissent, and this book is an outgrowth of that. And I found, in fact, after it was all over, after the commission had departed, having blamed the insufficient regulation for the financial crisis, after they departed, I got an awful lot of information from the files that was never showed to me as a member. And most of that information is now in the book. So if you really are interested in why we got to the place we are, this is the book that you should be reading. Now, I think we might have a little time for questions. Is that true? Okay.
If I could ask one real quick, Peter. Canada apparently doesn't have this problem because they have consistently asked for higher down payments. The question is, do you think it's possible politically for us to go to that if we get a new president with some kahunas and is willing to take the heat?
Yes, of course it's possible. It's possible to have good policies. But the important point, really, because as I explained, the government has a real incentive to reduce underwriting standards. It really helps them a lot. It makes the economy grow. So it's important for the American people to understand the problem. And that is, whoever is elected president is going to be told, well, you know, Mr. President, or Madam President, if you really want the economy to grow, all you have to do is start reducing some of these underwriting standards, and of course the economy will begin to grow more. That would be a gigantic mistake, and that's why if the American people are fully informed about why we had the financial crisis, we are much more likely to have a good policy no matter who is elected president in 2016. Yes?
I'm curious as to what you think of the incredible irony that none other than Barney Frank would be the author of DoddFrank, when Barney Frank in 1992 was served on the committee that recommended the reduction in lending standards. That was the very genesis of subprime mortgages, and he should be the one to regulate how that should be fixed in retrospect.
Well, of course, if you were Barney Frank, what would you want to do? You would want to blame the financial crisis on something else entirely. You'd want to focus everyone's attention on the risk-taking in the private sector rather than on the government's policies. So you can't blame him. But it is for avoiding the blame by authoring a law that focuses everyone's attention on the mistakes of the private sector rather than the policies that he endorsed and enforced. I was in the government at this time. I was at the Treasury Department in 1980, in the Reagan administration from 1981 to 1987, and I was also one who communicated a lot with people in the Bush administration in the 2000s, and they were aware that there was something going on at Fannie Mae and Freddie Mac. They didn't know exactly what it was because, as I said, Fannie and Freddie were not disclosing that they were taking credit risk. But people in the Bush administration were aware of this, and they started to draft legislation that would impose much stricter regulation on Fannie and Freddie than existed before. And who opposed it? Dodd and Frank, right. And so now they have their names on the law. They're heroes to the left. They're heroes. But to the rest of us in this room and the rest of Americans who see this, they shouldn't be heroes.
Yeah, I have a quick question. I was kind of surprised you didn't include any discussion of the role of credit default swaps in the recession and the amount of risk that a lot of the investment banks were taking on in the portfolios of CDSs that they had.
Well, for one thing, I don't have time to talk about things like credit default swaps, but they are covered in great detail in the book. And in my view, credit default swaps had no role whatsoever in the financial crisis. What a credit default swap does is it takes, I won't explain exactly how it does it because it gets a little technical, but what it does is shift risk from one area to another. It doesn't increase risk, but it takes risk from one company that is holding that risk and, in effect, assigns it to some other company. It's just like insurance. And if you have, well, let's say you have of course you do have fire insurance on your house. Now, if your house burns down, you're covered. On the other hand, if your fire insurance company fails, and this is the way that the issue is presented sometimes on credit default swaps, if a business that has written a credit default swap, like an insurance company, if it fails, the thought is, well, that means that everyone suffers losses in a case like that. But that's not true, because you can, if you haven't suffered a fire and your fire insurance company fails, you can go out and buy another fire insurance policy. And that's what most people did when they were worried, for example, about AIG. They went out and bought other credit default swaps to protect themselves in case AIG failed. And the credit default swap market functioned all through the financial crisis without any halt. Even though there were lots of problems everywhere else, the credit default swap market functioned fully and continued to operate. It is now much more heavily regulated than it was before, but the regulations, in my view, are simply imposing many more costs. They are centralizing the risks instead of putting the risks out, diversifying the risks throughout the financial system, where there's much more capital to take them. It is now centralizing the risks in various government-backed institutions called financial market utilities. And as a result of that, they are a likely cause, in my view, of another financial crisis in the future. The way we protect ourselves is by diversification, not by centralizing risk.
Peter, thank you very much. We're going to have to wrap up.